If a major war breaks out between Iran and Israel, it will have serious economic implications for China, primarily because of its dependence on Middle Eastern energy, its Belt and Road Initiative, BRI investments, and its global trade strategy. Here's a breakdown of the major implications. 1. Oil and energy security. China imports over 40% of its oil from the Middle East, with Iran and Saudi Arabia being major suppliers. War in the region would disrupt oil shipments, causing global oil prices to spike. China, being the largest oil importer in the world, would face higher energy costs, inflation, and slowed industrial output. 2. Belt and Road Initiative (BRI) disruptions. Iran is a key node in China's BRI, acting as a land bridge between Asia and Europe. War could destabilize infrastructure projects like railways, ports, and pipelines. Instability could also deter future investments in the region by Chinese firms. 3. Strategic dilemma and diplomatic pressure. China tries to maintain neutrality and good relations with both Israel, tech trade, and Iran, energy geopolitics. A war forces China into a tight balancing act, risking damage to one or both partnerships. The U.S. might pressure China to take a stance, affecting broader China-U.S. strategic competition. 4. Maritime route vulnerabilities. If conflict spills into the Persian Gulf and Strait of Hormuz, shipping lanes could be blocked. This would cause delays in China's imports and exports, especially oil tankers. China may have to rely more on costly alternative routes or strategic reserves. 5. Global economic slowdown. A regional war could trigger a global recession, reducing demand for Chinese exports. Stock markets may crash, and global supply chains could suffer, especially if the U.S. and allies get involved militarily. China's export-driven economy would be vulnerable to this turbulence. 6. Currency and investment shocks. Investors may pull money out of emerging markets, including China, and shift to safer assets like the U.S. dollar or gold. The yuan could weaken, leading to instability in China's financial markets. Foreign investment in China could also decline due to global risk aversion.